This is TechCrunch. On Thursday, insurance tech company Corgi announced a $106 million Series B1 raise, valuing the company at $2.6 billion, just 3 weeks after announcing a $160 million Series B at a $1.3 billion valuation, and 4 months after its $108 million Series A. The company offers insurance working specifically with startups in areas like tech, cyber, and general liability. It counts Deal and Artisan among its customers. Even in the current go-go deal-making environment, that sequencing is remarkable. While startups raising back-to-back rounds at steep step-ups have become, almost routine, a company whose valuation doubles in 3 weeks is unusual enough to raise some questions, particularly given the investor set in both rounds is the same. Asked what material event justified that kind of jump in such a short window, investor Kanye Macabella of Kindred Ventures cited the company's momentum. It's an explanation that may satisfy some, but the practice most generally is starting to attract scrutiny in LP circles. One LP, who backs numerous venture funds and asked not to be named in this article, said there is growing distrust of internal markups. If a company is just getting repriced upward with no real liquidity event, LPs notice. The specific concern is that a fund that invests in one valuation, then marks it up 3 weeks later, can make portfolio performance look stronger on paper than the underlying business may justify. In this case, Macabella suggested that's not an issue for Kindred's limited partners nor for Corgi's other investors, which include Prime Capital, LeBlanc Capital, Alumni Ventures, and Y Combinator. Macabella, in a message to TechCrunch, said, LPs really like exits above all. They discount the value of markups, since those are not always reflective of reality. And he added that in this case, revenue growth rationalized the new round. Founded back in 2024 by Emily Yuan and Nico Lacqua, Corgi says it's building coverage for what it calls newer categories of risk, which also addresses an often underserved market among legacy insurance carriers, startups, and the unique liability problems they face, including those related to artificial intelligence. Lacqua told TechCrunch, Corgi covers anything from when an AI system causes financial loss, misinformation, operational failures, or compliance issues. Many legacy policies either exclude those risks or handle them ambiguously. Now, Corgi is not alone in the insurtech market. Vouch, which is backed by Y Combinator, operates in a similar space. When asked about the back-to-back rounds, Lacqua said that insurance is a highly capital-intensive industry and that demand has accelerated quickly across new product lines and partnerships. Building an AI-native platform compounds those costs further. Lacqua said, we're best known for our business insurance products, but the additional capital will be used to expand into new insurance categories, scale the AI underwriting platform, grow embedded distribution partnerships, and continue growing our team. Corgi has now raised $378 million in total funding from its investors. Anthropic has snagged $65 billion in funding at a $965 billion post-money valuation in its latest funding round, marking what could be the AI startup's last private fundraising before debuting on the public markets. The Series H round was co-led by Altimeter Capital, Dragoneer, Green Oaks, Sequoia Capital, Capital Group, Coitu, D1 Capital Partners, and others. Institutional investors included Bailey Gifford, Blackstone, Brookfield, D.E. Shaw Ventures, DST Global, and Fidelity Management and Research participated in the round. Strategic infrastructure partners, including Samsung, SK Hynix, and Micron, also joined the round. A portion of the round, $15 billion, is also made up of previously committed investments from hyperscalers, including $5 billion from Amazon, announced back in April. Now, TechCrunch reported last month that Anthropic was close to closing a $50 billion round, with investors clamoring to get on the cap table. One institutional investor had even pledged as much as $5 billion just to get a meeting with Anthropic CFO Krishna Rao. Anthropic plans to use the new funds to advance its safety and interpretability research, expand compute to meet the growing demand for Claude, and scale the products and partnerships that their customers rely on. The round comes the same day that Anthropic released its new Claude Opus 4.8 model, which touts better capabilities in agentic tasks, advanced coding, and focuses on honesty and self-correction. The AI startup is also reportedly planning to more widely launch models that are on par with its powerful cybersecurity model, Mythos, which has only released in limited fashion due to potential safety concerns. The company has seen increased growth since its last funding round, particularly among enterprise customers that rely on Claude Code. The company said its run rate revenue crossed $47 billion earlier this month. The Wall Street Journal recently reported that the startup expects a 130% revenue surge to bring it to its first operating profit. Brad Gerstner, founder and CEO of Altimeter Capital, said Claude's latest advancements have driven large-scale adoption among the world's most demanding organizations. This momentum positions Anthropic to lead the next phase of AI innovation and capture the enormous opportunity ahead. Anthropic has been in tight competition with OpenAI for fundraising and user growth in advance of their respective IPOs. Earlier this year, OpenAI last raised a whopping $122 billion round in March at an $852 billion post-money valuation. Elon Musk's SpaceX, which merged with xAI earlier this year, is targeting a $2 trillion valuation in its pending IPO and seeking to raise more than $75 billion. That's all for now. This episode featured reporting from Dominic Midori Davis and Rebecca Balan. For the latest tech news, go to TechCrunch.com.